Hello and welcome to this video session on IAS 16 property plant and equipment, in particular the application of IAS 16 property plant and equipment with regards to revaluation. Okay, so if you have struggled with the concept of revaluation, want to understand more, or just want to refresh your knowledge, please stay tuned because that's what we'll be going through as part of an exercise. But before that, I was just looking at annual reports of Rolls-Royce for 2018. Those are the latest reports available on their website. Now, the figure property, plant and equipment caught my eye, and the figure is 4,929 million pounds. It's a significant amount, okay? And it's just, can you imagine, it's a single figure. We don't know yet where they have got that figure from, okay? How they calculated it. But the whole point is that if you want to know more about it, where those figures are coming from, you need to go to the associated note. So next to the figure, you can see note number 10, reference to note number 10. So we go to note number 10, in which they describe how they applied the accounting policies related to IAS 16, what were the costs, what changes did they make during the year, and therefore how they arrived at the net book value at the year end. So that's what it is. At first look, it may look scary. Okay, trust me, it does look scary, but really it is not. Once you start understanding it, it really becomes very simple. And that's the whole point of today's video, to demonstrate how this kind of notes are prepared, really. So what we are seeing over here is the first section that you would find, or the first account that you would find in the note, and that is all about cost of the PPE. They have land and building, they have plant and equipment, aircraft and engines in course of construction, so they have some work in progress as well, and the total figures. And in the cost, they start with the start of the year cost. Okay, that's over here, 1st January 2018, and before that, when they have had made changes to their policies, they had to restate it. So that's what they are providing at the start. But really, the what interests us starts from here. So it's from January 1st 2018. They had some assets, then they bought some, they disposed some, they transferred some assets to held for sale category, disposals, reclassification, exchange differences, and the cost at 31st December 2018. Sadly, we don't have any revaluation. The company did not revalue any of the assets during the year. But what we'll go through will show you how they would account for the revaluation if there was one during the year. The second account you will find is the accumulated depreciation. The same kind of process, start of the year, changes during the year, year end. And once the accumulated depreciation account is deducted from the cost, what you find is the net book value, which is the last section over here. And there you go, a figure, right, which we found in the balance sheet, 4929. Okay, that's how they arrived at it. So let's just go back. So that's the total cost on 31st December 2018. From that, minus 3,972 million, and boom, we have got the net book value. Okay, so that's the kind of structure we are trying to learn today, right? And hopefully after today's session, you will be able to relate with this kind of notes better. Okay, so that's the whole point. So for that, I have a nice example, really, and the example is called Draco PLC. Brilliant example, very simple. And what it contains is that the company has provided its trial balance, okay, with some figures, typical figures that would go in income statement or statement of profit or loss, as you would call it, and figures for the statement of financial position. So those are the figures given to us. I'm not going to read through it. Perhaps if you want to pause the video and read through the question, you can, the trial balance. I'm more interested in the adjustments for the year end, because the year end adjustments include the adjustments on PPE, property, plant and equipment. So the first adjustment is that the year end inventory is £60,000. We need to account for it. We will. Then we have land and building. What's going on in land and building? Let's have a look. On 1st January 2019, Draco PLC revalued its land and building to £2 million. Brilliant. Okay, so in the trial balance, we have been given value of the land and building. Here we go, 1500 or 1.5 million, working in thousands, by the way. So 1.5 million includes 300,000 pounds worth of land and 1.2 million pounds worth of building. So put them together, 1.5 million. Now that land and building, the property, was revalued to 2 million pounds. Land is going up to 600,000 and building is going up to 1.4 million. The remaining useful life of the building was revised to 50 years. Okay. Now, before the revaluation, the building was depreciated over 60 years. Draco uses straight line method to depreciate its building. Now, usually the standard provides choice to the companies what happens to the excess depreciation, what happens to the revaluation gain, how would you recycle to retain earnings? Because at the end of the day, if you revalue an asset, it's going to be a paper gain, for example, and because of that, there will be higher depreciation, which will be hitting statement of profit or loss and reducing our profits. So in order to compensate for that, the standard provides a choice. Either the gain is recycled to retain earnings when the asset is disposed of, one, or sorry, second choice is that we transfer the excess depreciation annually from the revaluation surplus to retain earnings. So those were the choices. Now, for the simplicity purposes, I'm ignoring that part because I want to just focus on the accounting for the revaluation at the time when the revaluation happens, and then at the year end when we work out the depreciation. Okay, so let's move on. And then we have plant and machinery. Plant and machinery should be depreciated at 10% reducing balance basis. Okay, so the property or building is depreciated on straight line. Okay, previously over 60 years, now it's going to be 50 years. Plant and machinery, 10% reducing balance basis. And we have been given land and building cost and building accumulated depreciation account on 1st January 2019, plant at and machinery at cost 500,000, and plant and machinery accumulated depreciation on 1st January 2019, 150. Okay, so and depreciation should be charged to operating expenses. Usually companies decide as to whether it is a production cost or it is an operating cost, the depreciation, and that's where it will go. So in this example, we are assuming the total depreciation will simply take to operating expenses. So what we are required to prepare is a statement of profit or loss and other comprehensive income. If you are aware, the other comprehensive income section contains the unrealized gains and losses, okay, equity gains and losses, which won't go in the statement of profit or loss. So the gain that we will calculate on the building and land revaluation will go in the comprehensive income. Statement of changes in equity also contains this revaluation column in which we'll have to record the revaluation gain, and statement of financial position as of 31st December 2019. Okay, and then there is another adjustment number 4, but I will ignore it for the moment, and we'll come back to it at a later point. Okay, now I'm not going to prepare the entire set of financial statements based on the trial balance. Okay, I assume that you are able to do that. The objective of today's video is to look at solely the property, plant and equipment adjustment. So please, if you can at this point, perhaps create statement of profit or loss, other comprehensive income, statement of changes in equity, a statement of profit, financial position, with all those balances excluding property, plant and equipment related items, so we can deal with that later. To help you with that, let's have a look what items would go in that. So that's over here. Yeah. Sales revenue, and then in cost of sales we have opening stock, Just move it here and move this here and make it tidy. Yeah, that's it. Yeah. So sales revenue, cost of sales, opening inventory 100, purchases 600, closing inventory 60, and that is coming from notes. Yeah, 60,000 over here, and the rest is coming from the trial balance. Then we have gross profit. You work out the gross profit. Operating expenses. Now I'm leaving it in an adjustment column for now because there will be depreciation affecting this balance, so we'll have to bring that in. So leave that alone for now. Don't transfer that balance in the main pound column. Okay, then we have finance cost, which is given again in the trial balance. Profit before tax, deduct tax, profit for the year, and then this section on other comprehensive income, right? Ignore the total for now because the totals are going to be automatically adjusted once we carry out the transactions and adjustments. So other comprehensive income includes this kind of equity gains and losses. So in this case, it will be the revaluation gain that will be recording over here. Then statement of changes in equity for the year ended 31st December 2018 contains opening balances of ordinary share capital, retained earnings, revaluation surplus, and then last column total. Yeah, so all these balances are coming from trial balance, as you can see from here. Okay. Profit for the year is, again, ignore the total. It is cell reference. So once we have found the right total for statement of profit or loss, this should be automatically adjusted and it will change. And one more item will be there, which is the revaluation surplus or revaluation gain that we are going to calculate later on. Then the non-current assets in statement of financial position. The first item will be PPE, property, plant and equipment. We'll have to prepare a note for that to find the net book value or carrying value. Then we have current assets. Okay, that's 210 coming from the trial balance, and the 60 is the inventory. Okay, closing inventory. So double entry for inventory is debit current assets or inventory in statement of financial position, and credit cost of sales in statement of profit or loss. Okay, so that's how we put 60 in statement of profit or loss and 60 in the current assets. Now in the equity and liability, ordinary share capital, retained earnings, those totals are coming from the statement of changes in equity. If there are adjustments, they will change. Again, there are cell references, so ignore them for the moment. Then we have revaluation reserve. Currently it's 10, which is coming from here. Once we have the gain, it will be adjusted automatically. Then non-current liabilities, in which you have loan notes and current liabilities worth of 90. And then total equity and liability. Again, the figures don't match. The totals, they will match later. Okay, then let's jump on to the notes section, right? So this is our notes section, lowly notes section, and I have divided into, actually, let's call it 3 categories. So the first one is, let's call it cost account. Oops, what's going on? Cost account, yeah, just like we saw in Rolls-Royce. The second one is accumulated depreciation account, and then the last item or the third section will be the net book value, or we like to call it carrying value. Yeah, carrying value, right? And then underneath that I have got a nice adjustment. Oops, some figures there shouldn't be there. Let's remove them. Revaluation working. Okay, so some of the revaluation figures that will go in the notes will come from this working. Excuse me. Okay, so let's pick the figures from the trial balance and the notes and fill them in. So the first thing we need, by the way, yes, note format. So in the PPE note format, number 10, if you remember from the Rolls-Royce, we have note number 2 for that. We have land, we have building, we have plant and equipment, and total. We could have combined land and building, but so to show you the effects on these 2 items separately, we have kept the account separate. Otherwise, they are kind of together. Okay, so the cost, and then opening balances. Okay, opening balances are coming from the trial balance, and those are like this. Okay, right, come on, right. Okay, opening balances, and then accumulated account opening balances, or you can call it, if you want to, balances on 1st of January 2019. Yeah, oops, something wrong. Okay, let's just type in, shall we? So that's, oops, did I make a mistake here? Yes, I did. Yes, I did. Figures are wrong. Figures are wrong. Should not copy and paste. Okay, so the land, in fact, was 300. The building was 1200, and plant and equipment were 500. See, now it works. Then let's do the total here, and that will give us total. So here, an opening balances for the accumulated depreciation account. Phew, that was close. So that's land. Does land get depreciated? No. So building does get depreciated, 300. Plant and equipment, 150. Yeah, opening balance is done. Now, okay, what shall we do next then? I think we should deal with the revaluation first, because the company hasn't accounted for it, and that's the first thing happened during the year. If you notice the date in the question, it says 1st of January 2019. This is happening. Okay, so on 1st of January 2019, this is what is happening. Revaluation. Okay, revaluation is happening. So let's do the revaluation here. Okay, and then let's deal with the revaluation here in accumulated depreciation. I'll explain that in a second what's going on, right? Let's fill those details in first. So in order to find revaluation, first of all, we need to work out what the carrying value of the asset was at the date of revaluation or before the revaluation, what the revaluation amount was, and therefore whether there was a gain or there was a loss. Okay. Now, if you notice, I've done working number 2.1 or note number 2.1 over here, which talks about the revaluation, provides the figures. So let's start with the carrying value first of all, shall we? So we know that the carrying value for the land and building on 1st January 2018 would be the cost 1500, total cost, minus accumulated depreciation. Okay, and that is 1200. Okay, so we know that 1200. What was the revalued amount? Well, it was 2 million, wasn't it? So revalued amount, okay, working in thousands, so rounding up, of course. Okay, so if you want, we can put some zeros on the top so we know. Let's copy and paste and paste again. Right, okay, so the revaluation gain we can see is 800. Let's call it revaluation gain. Okay, revaluation gain. Now, how would you account for this gain on 1st of January 2018? Okay, this is how. It will be in 3 steps, or 3 parts of the double entry. So the first thing first, we need to write off all the accumulated depreciation account existing on the building on the day of revaluation. Assume that you are getting rid of that building and replacing it with the new one. So everything related to that building should go. Okay, so the accumulated depreciation account, we know 300, and that needs to go. So if we want to put a detail or details over here, we can say remove from accumulated depreciation account. Okay, so that's step 1. Step 2 is, okay, step 2, I'm just going to move step 2 here, right? Because I want to keep one space, because there will be a balancing debit entry. We need to credit whatever gain we have made in the revaluation surplus account. So gain is 800. So let's move that here. Now you can see credit is 800, debit is 300. Therefore, balancing figure or B will be on debit side. Okay, so that will be the cost of land and building. Okay, cost of land and building, and that is going to be 500. Oops. Okay, so now let's put the details for these two items. So the gain will need to take to revaluation surplus, and this 500 is going to increase, okay, the cost of land and building. So cost of land would increase to 600,000 as given in the question, remember, 600, and building will go up to 1.4 million, so increase by 200. Cool. So that's what we want to do now. Right, so go back to the note, the revaluation, land. Okay, land is going to go up by, how much did we say? 300, and the building will go up by 500. Altogether 800. Am I right? Yeah, good. So now we have the totals. You can see, so the cost totals are done. Now, accumulated depreciation account, what did we say should happen to the existing accumulated depreciation on building? That should go. So that's the debit side. Okay, done, right? And so we have done the two debit sides. We have increased the cost of the asset. Okay. Sorry, this one should be, sorry, my fault, it should go up to 1400, isn't it? So 200, the building will go up by 200, so 1400. Oops, number two, it's not going to happen again. Mistake number two. All right, so 300 and 200 altogether 500 debit side. That one, yeah, yeah. This one, remove the accumulated depreciation due to revaluation, gone. And then we need to put this gain of 800 in our financial statement. So first of all, I'm going to start with the statement of other comprehensive income, put revaluation gain there, okay, and that is going to be 800. Please note that this section is in yellow, right? The reason why it is in yellow is because it doesn't form part of double entry. Okay, it's just kind of a memorandum, extra set of information that you're providing to your shareholders. Companies are providing to their shareholders that, by the way, on top of all this income and expenses that we have recorded in statement of profit or loss, we have this equity gains and losses as well. Okay, there are other equity gains and losses that would go in here. For example, the foreign exchange gains and losses on when you are translating assets or liabilities from foreign currency to the home currency, or it could be the financial instruments related gain, where you have financial instrument or financial asset which is fair value through other comprehensive income category, many other items. So don't worry about those for now. Let's focus on the revaluation gain. So 800 gone in there, and then in other comprehensive income we also need to record it, revaluation gain, and as soon as we put that in, hopefully that will change, the total will change to 810, and that will filter through to the equity section here in statement of financial position. Can you see that? So that is revaluation gain. Good, done. So we have done those entries, and now let's assume we are at the year end. Okay, now we are at the year end, 31st December 2019. I know it's in future, but let's assume we are at 31st December 2019, and we are going to calculate now the depreciation on building and plant and equipment. So the depreciation charge, first of all, the building. Now, if you remember, the value of the building has just changed to 1400. Okay, so and that is going to be depreciated over 50 years as per the question. That's the new revised life of the asset. When the revaluation happens, the value changes, or as well as the life of the assets might change as well. So 50 years, and that is going to be 28. Okay, and then plant and equipment. We know it's a reducing balance basis, so we need to take the opening balance of plant and equipment cost minus accumulated depreciation, and we get 350,000 multiplied by 10%. That should give us 35. Okay, job done. So now, as you can see, we have got nice little figures here. So these are the closing balances. Let's call it revised cost on 1st January 2018 or 31st December, we call it 31st December, okay, 2018, and that's accumulated depreciation on excuse me, 31st December 2018, and this is the carrying value of property, plant and equipment on 31st December 2018. How did we get these figures? Okay, so if we call this A, yeah, revised cost on 31st December 2018, let's call this B, and therefore the carrying value will be A minus B. Cool, that's it. That's really it. So we have found our figure, which will go in statement of financial position for the property, plant and equipment. Okay, and oh, it's not there. Okay, it's there. Okay, so it is already there, and if we call it property, plant and equipment, okay, as per note 2, again we are giving reference just like the company, okay, so that's that. But the totals are not the same. They're not. That's because we haven't accounted for this depreciation yet. We need to do that. So we know, do you remember where it goes? Operating expenses as per the question. So we are going to give 28 here and 35, and let's call it note 2. Okay, and that is going to be $263. You can see the profit for the year changes, total comprehensive income changed, and the profit in the retained earnings section also changed. Okay, and oops, oh, that should be minus, shouldn't it? If that is not minus, that is going to be a problem, because the balances will not be equal. Now they are. Okay, so the profit figure is 272, goes into the retained earnings, straight to the totals, closing balances, and that filters through to the statement of financial position. Good. So yes, let's quickly recap. Is if you have a revaluation affecting your property, plant and equipment, you need to find out the carrying value of those assets on the date of revaluation, what the revalued amount is. That will give you revaluation gain. Write off all the depreciation, remove them. Okay, remove that existing depreciation. Account for gain or loss on that day. Okay, either do statement of profit or loss or revaluation surplus. I'll explain that later in a minute. But this is revaluation surplus because it's a gain, it goes to revaluation surplus. And any kind of balance sheet figure will either increase or decrease the balance of PPE. Cool, good. Now let's look at the last note over here, which says how would your note to PPE change if the land and building were to be revalued at 1 million. Oops. So the cost was 1.5 million. By the way, this is an independent transaction, nothing to do with the rest of the question, right? So we are assuming instead of this happening in note 2, where the land and building goes up, it's going to go down, okay, to 1 million. How would it change? Land becomes 100,000, building at 900,000. Okay, so let's account for it now. Again, the same thing. We will need the revaluation note. Shall we call it 2.1 again? Yeah, let's call it 2.1, and that is PPE, which is note 2. Okay, exactly the same form you can see. All right, so carrying value as we know it. Okay, don't want to dwell on it too much because we already know that. 1200. Okay, and then the revalued amount is 1000 in this case, and that gives us a revaluation loss of 200. Okay, now how are you going to account for the loss? The standard says that if there is a revaluation loss, it should go to the statement of profit or loss right off straight away instead of going to revaluation surplus. However, there is a clause. The standard also says that if you have a gain on those kind of assets sitting in the revaluation surplus, okay, from the previous revaluation, then the loss must be settled against that gain first before you hit your statement of profit or loss with that kind of loss, which also makes sense as well, because the statement of, you don't really want to touch the statement of profit or loss if you already have a revaluation gain sitting in the revaluation surplus. Write it off first and then move on to the statement of profit or loss. So number one, in terms of double entry, remember what that is? I think you should. Accumulated depreciation account. Okay, write it off. We don't want it. So that goes. Okay, then second is how much do we have in the revaluation surplus at the start? If you scan the trial balance, you'll see that there is already 10,000 sitting there, so we have to use that first. Okay, so let's use it up. Okay, and that is that. Okay, first set off the loss against the available revaluation surplus. Anything left, move that to statement of profit or loss. Okay, how much left? How much left? We have used up 10. The loss is 200, so we need to use up remaining 190,000. So let's do that. So remaining goes to the statement of profit or loss, 190,000. Okay, 200 minus 10, and then that means our credit side is short by 500. So we're going to reduce the cost of the asset by 500, which also makes sense because land and building originally were worth 1.5 million, is going to go down to 1 million, so loss of 500. Okay, and that is your land will go down to 100,000 and building will go down to 900,000. Okay, then let's prepare our PPE. So first of all, the cost as before, then revaluation, land will go down by 200 and building will go down by 300, so altogether million revised cost, okay, on 31st December 2000 and are we 18 or 19? 19, isn't it? Yeah, 19. Why are we working in 18? Why? This should be 19. Okay. Anyways, and this one should be 19 too. The start of the year is 19, of course. Okay. Then accumulated depreciation. Right. Opening balances, because of revaluation, get rid of it. Okay. And then depreciation charge. Building will be depreciated over 50 years. Same, no changes. So this is going to be million over 50 years, and that should give you 20. So positive 20, and plant and equipment, no change. Okay, and that should be 35 as before. Okay, so as you can see, the net book value changes to 1295 already. So this is the revised, or sorry, you can just call it accumulated depreciation on 31st December 2019. This should be 19 as well. Ignore this, please ignore this. I don't know why I said it as 19. Anyways, so that's that. So when you have a downward revaluation, make sure that you write off the depreciation first, then use up anything in the revaluation surplus account, and then anything left, then that should be transferred to statement of profit or loss. Okay, so that means we prepare the extracts for these financial statements. Yeah, so the first one is the statement of profit or loss 2019. Okay, so let's go to statement of profit or loss. Operating expenses. Okay, operating expenses. As we know, operating expenses from the trial balance were 200. Then there was a loss of revaluation 190, depreciation 20 and 35. Altogether is 445. Okay, other comprehensive income will include, you know what, the loss on revaluation. Okay, which was here, right? Not part of double entry, but should be recorded. Okay, statement of changes in equity. Statement of changes in equity should have opening balance, revaluation loss, and closing balance, as because we are just preparing that column. Okay, you don't have to prepare the ordinary share capital and the columns. So let's record that here. Opening balances is 10. Change is 10, and therefore closing balance is 0. We are using up everything. And statement of financial position, we have property, plant and equipment 1.295 million, and an equity revaluation surplus of 0. Okay, so whatever notes that we prepare underpin how we prepare the financial statement. So all the figures are transferred from there to here. Ignore the 19s. Yeah, so ignore the 19s to this 2019. Brilliant. Okay, so I hope you enjoyed this session and you understood how the notes section work, and have now a bit more confidence as to how to read those notes. We have dealt with one very important issue of revaluation, but there are other items such as additions, disposals, impairments, etc. So that's something we'll deal with in future. Okay, thank you for watching.